Imagine for a second, right, that you're holding shares of a massive tech giant, like, say, Apple or Microsoft, in your retirement account.
Yeah, which, most people are.
Exactly. And on the surface, it feels like a completely standard, solid play on innovation.
Oh, absolutely. It's
Yeah.
the default move for sure.
Right. But what if the billions of dollars those companies just hold in cash, generating interest in these massive institutional bank accounts, technically invalidates your entire core investment philosophy?
That's the part that really catches people off guard because you suddenly realize that a few cents of interest buried deep in a corporate balance sheet forces you to completely rethink your entire portfolio.
Yeah, suddenly buying an index fund isn't just about, tracking returns anymore. It becomes this deeply intentional exercise in tracing the actual financial DNA of every single company you own.
Exactly. It forces you to look completely under the hood. You aren't just looking for the best yield anymore. You're mapping out exactly how that yield is generated, what kind of debt was used to leverage it, and what industries it actually touches.
Which is just a perfect lens for the financial framework we are dissecting today. Welcome to the Deep Dive, everyone. We have a really fascinating mission for you today.
You really do.
We are exploring this massive, comprehensive stack of guides and market intelligence from a source known as Coach Zubair. And it unpacks the intersection of ancient Islamic financial principles and, well, modern investing.
Yeah, and our goal here is to decode how you navigate the modern stock market, gold, and even the wild west of crypto without compromising these core foundational rules.
And perhaps most surprisingly, we're going to find out how the most seemingly boring strategy might actually be the mathematically optimal one.
Because, halal investing isn't just a random list of arbitrary restrictions.
Right, it's not just a bunch of don'ts.
Exactly. It's a highly structured framework. It points capital toward equity in real, tangible businesses. It deliberately steers your money away from opaque financial engineering.
And toward industries that actually contribute to society rather than exploit it.
Yeah.
Okay, let's unpack this, because before we can even look at specific assets, we have to understand the ground rules.
For sure. You need the foundation.
Right. And the entire framework basically rests on three foundational no's, right?
Yeah, three big ones. First, no riba. That literally translates to no interest.
So conventional bonds are just out immediately.
Out entirely. But it also means companies that rely heavily on debt financing to operate are screened out. And then second, no haram industries.
Which is the stuff most people probably guess, right?
Yeah, exactly. This means avoiding companies involved in weapons manufacturing, gambling, alcohol, tobacco, adult entertainment, and pork.
Right. And then the third one is where it gets really applicable to modern markets, I think.
Yes, no gurar, which translates to extreme speculation, deception, or uncertainty.
So in practice, that's ruling out all the crazy Wall Street stuff.
Basically, yeah. It rules out most complex derivatives, leveraged products, and options trading where the outcome is just entirely speculative.
Wow. Now, one concept from the sources that really highlights the meticulous nature of this framework is purification.
Oh, yeah, this is so interesting.
Right. Let's go back to that tech company example. You buy a completely compliant software business, but they inevitably have operational cash sitting in accounts that generate like a tiny fraction of a % in interest.
Yeah, they just have to for payroll and stuff.
Exactly. And the framework actually demands that you account for that tiny fraction.
It's this really fascinating mechanism of financial hygiene. The practical application works like this if you hold shares in that compliant company and it earns, say, 0.5% of its income from an incidental interest-bearing account. You have to do the math.
You actually have to calculate it.
Yeah, you calculate your exact share of that non-compliant income from your dividends. Then you donate that exact amount to charity.
That's incredible.
And you do it without expecting any spiritual reward for the donation. You literally cleanse your portfolio by skimming off the accidental non-compliant gains and just giving them away.
I mean, the administrative tracking required for that used to be a total nightmare for retail investors.
Oh, historically, it was nearly impossible.
Yeah, which is why the sources point out that modern ETF providers and apps actually calculate that purification ratio for you now, which is super helpful.
It makes it incredibly seamless for you today.
But moving past the restrictions, what are you actually aiming to hold? Because the sources point to owning a real business as the most universally agreed upon investment.
Right. The classical Arabic terms there are musharaka and mudaraba.
Yeah, and to make this concrete for you listening, think of musharaka, which means joint ownership, like splitting the cost of a riding lawnmower with your neighbor.
That's a really great way to visualize it.
Thanks, yeah. So you go in the equipment 50-50, and you start a weekend landscaping business together. You share the profits from mowing lawns.
But importantly, if the engine blows up and needs a $1,000 repair, you share that loss too.
Exactly, you're in it together.
If we connect this to the bigger picture, that lawnmower arrangement represents the exact underlying philosophy of buying a fractional share in a public company.
Right, because you're bearing real risk.
Precisely. There are no guaranteed fixed returns in this framework, which is exactly why conventional bonds are forbidden. There is zero separation between the investor and the outcome of the business.
You succeed if the enterprise succeeds, and you absorb losses if it fails, which flows perfectly into how Coach Zubair actually suggests executing this in the market.
Right, moving from theory to practice.
Exactly. The recommendation is what he calls the Tier 1 strategy, which is dollar cost averaging into broad index funds and never stopping.
Just relentless consistency.
Yeah. And for an audience that tracks the markets, you know what DCA is. But what's compelling here is why this specific strategy aligns so perfectly with Islamic principles.
It has everything to do with avoiding that concept of gharar speculation.
Right.
When retail investors try to actively time the market, it really often crosses the line from measured investment into speculative gambling.
Oh, for sure.
And this isn't just a theological stance, right? It is overwhelmingly supported by traditional market data. The sources reference the S&P SPIV scorecards.
Those numbers are wild.
They really are. They show that over a 15-year window, 89.5% of full-time professional active fund managers actually lose to the index.
Wait, 89.5%?
Yes, nearly all of them.
And the Dalbar studies in the notes show it's even worse for individual retail investors. Like when people try to time the market panic selling at the bottom, buying the hype at the top, it creates an 8.5% gap in their returns.
Just from bad behavior.
Exactly, compared to simply holding the fund. So by utilizing a boring DCA strategy, you remove the emotional speculation, you avoid gharar, and you align perfectly with the passive investing logic championed by giants like Warren Buffett and Jack Bogle.
Yeah, you were simply taking that proven passive investing logic and just running it through a compliance filter first.
So let's talk about the mechanics of that filter. Because if buying the whole market is the best strategy, but we have these absolute rules against interest and forbidden industries, how does a modern halal ETF actually function?
It takes some serious financial engineering.
Right. An ETF provider has to take a conventional index, like the S&P 500, and run every single company through specific standards, usually set by AAOI, the Accounting and Auditing Organization for Islamic Financial Institutions.
And those standards rely on very specific mathematical thresholds.
Okay, lay them out for us.
For a company to be included, its total debt compared to its total assets must be under 33%. Additionally, any revenue from forbidden activities must be under 5%.
So if it passes, it gets in.
Exactly. If a company passes those tests, it makes it into the ETF.
I want to dig into that 33% number, actually.
Yeah.
Why 33%?
That's a common question.
Because to an outsider, allowing a company to have a third of its assets tied up in debt seems totally contradictory if the core rule is no interest.
It's a very perceptive question, honestly. In classical Islamic jurisprudence, scholars often rely on a principle where 1/3 is considered the threshold for something becoming substantial or abundant.
Ah, yes.
Yeah, if something is below 1/3, it is considered a minority component. And in the complex reality of modern global equities, it is virtually impossible to find a publicly traded multinational corporation with absolutely zero debt.
They just don't exist.
Right. So the 33% ratio is a pragmatic, scholarly consensus. It allows participation in the modern economy while ensuring the company isn't fundamentally driven by leverage.
Okay, but I have to push back on the other side of the balance sheet.
Go for it.
We talked about Apple and Microsoft earlier. They sit on tens of billions of dollars in cash, which absolutely generates interest. How do they pass the test of keeping interest-bearing assets under 33%?
Yeah, that specific issue is one of the most intense scholarly debates in this space right now.
I can imagine.
Under a strict, literal reading of the cash ratio test, many big tech firms would actually fail. However, mainstream Sharia indices look at the consolidated balance sheet.
What does that mean in practice?
They argue there's a vital difference between operating cash, The massive liquid reserves a company like Apple needs just to execute its daily global supply chain, and pure financial assets held solely for speculation.
Oh, that makes sense.
Most mainstream scholars accept this distinction, but a minority of scholars still heavily critique it.
Which means this landscape is incredibly dynamic, right? A company's balance sheet changes every single quarter.
Oh, constantly.
They might take on a massive loan tomorrow and suddenly fail the 33% test, getting booted from the ETF at the next rebalance.
Which is exactly why the ETF landscape is growing so rapidly. You have funds like SPUS for core U.S. equities, SBTE for tech-focused, higher volatility exposure.
NASDAQ.
Exactly. And SPRE, which screens for low-leverage real estate investment trusts. There is also SPSK, which acts as the fixed income alternative by holding Sukuk.
Right, and Sukuk is different from a bond, right?
Very different. Sukuk are asset-backed certificates representing ownership in a tangible asset, completely different from traditional debt-backed bonds.
Got it. And for individual stock picking, the sources highly recommend using dynamic tools like Zoya, Musafa, or Islamically.
Yeah, those are great apps.
Because they calculate those exact AAOA ratios in real time for you. So we've established how the rules bend slightly for modern digital equities, relying on that one-third threshold.
Right.
But what happens when we look at actual historical money? Because when we talk about gold and silver, those buffers disappear entirely, right?
Oh, yeah. The rules become absolute. In Islamic jurisprudence, gold and silver are classified as ribawi items.
Ribawi items.
Yes. Because they are the foundational mediums of exchange, the rules demand actual hand-to-hand exchange to prevent the creation of artificial money.
Meaning absolutely no deferred delivery. You cannot trade gold futures.
No futures at all.
And there is zero margin or leverage allowed. You literally cannot borrow money to buy gold. But when you are buying gold through a modern brokerage account, how do you ensure hand-to-hand exchange?
It all comes down to the ownership structure of the vault. You have to ask, is the vault fully allocated or is it a pool?
Okay, let me try a visual analogy for you listening to break down the mechanics here.
Let's hear it.
Think of buying gold like using a valet parking garage. Fully allocated means when you hand the valet your keys, they park your specific car in a specific numbered spot. When you return, you get your exact car back.
Perfect.
Right. Unallocated, or a pool structure, means you hand them your keys, they sell your car to generate capital, and when you come back, they just guarantee they'll give you a car of the same make and model from a massive fleet they own.
That's exactly how the banking system treats gold pools.
Yeah. And for gold, the Sharia rules say you need your exact car. You need your specific serialized gold bars.
What's fascinating here is how that translates to real-world financial products, specifically under AAOIFI Standard Number 57.
What do the sources say is the best way to do that?
According to the guides, the absolute strongest halal structure is using the Questra trade desk for segregated physical gold. Your specific bars with your specific serial numbers are separated in a vault.
Wow.
But perfect compliance comes with a steep cost. It carries a 1.5% annual storage fee.
Ouch. That eats into your compounding returns incredibly fast.
It really does. So investors have to weigh that against ETFs like PHYS or PSLV. These funds hold fully allocated bars at the Royal Canadian Mint, which is excellent.
And there's a catch.
But you own fund units, not the bars directly. Most scholars accept this as constructive ownership, but it's considered a slight step down in purity.
Right, and then you have the pool structures like MNTTO or Wealth Simple Gold.
Yeah, which are incredibly convenient with very low fees.
But they raise a major Sharia concern because you only own an undivided fractional claim on a pool of metal. You're getting a car back, not your car.
Exactly. It perfectly illustrates the premium you sometimes have to pay for structural certainty.
Okay, so we've gone from the oldest tangible money to the newest, most intangible asset class imaginable.
Crypto.
Crypto. Here's where it gets really interesting. How do classical Islamic jurists even begin to evaluate something like Bitcoin or Ethereum when the foundational texts were written centuries before a computer even existed?
I mean, this is undoubtedly the single most debated topic in contemporary Islamic finance.
I bet.
Scholars have to rely on analogy. They compare the technical characteristics of cryptocurrency to concepts that actually do exist in classical jurisprudence. And because different scholars weigh those analogies differently, you end up with two very distinct camps.
Okay, let's start with the permissible camp. This includes scholars like Mufti Muhammad Abu Bakr, Joe Bradford, and institutions like Malaysia's Securities Commission.
Yeah, the heavy hitters on that side.
They view cryptocurrency as mal, which translates to property or wealth.
Their foundational argument is that Bitcoin has real utility, it can be seamlessly transferred, and a significant portion of society increasingly accepts it as a store of value.
Kind of like digital gold.
Exactly. Furthermore, its limited supply of 21 million mathematically mirrors the scarcity of precious metals. Most importantly, simply holding it doesn't involve earning interest. It's a peer-to-peer exchange mechanism.
But even the scholars who permit it have massive caveats.
Right away.
It must be spot trading only. You buy the actual coin, you hold it. On the other side of the aisle, you have the impermissible camp. And this is led by some very heavyweight voices, most notably Mufti Taqi Usmani.
Right, the president of the AAO-IFI Sharia board.
Yeah. And his view is just fascinatingly blunt. He calls Bitcoin an imaginary number.
It's a strong stance. The argument here is that it has no intrinsic value and lacks any sovereign backing. From this perspective, the extreme price volatility looks too much like Gharar uncertainty.
And the fact that the broader crypto market is dominated by pure speculation rather than real-world commerce makes it resemble Maysir or gambling.
Precisely.
And that debate is just about Bitcoin, which is relatively straightforward. How do they handle the mechanics of Ethereum?
That's where it gets really complicated.
Specifically, Ethereum's proof-of-stake mechanism. You lock up your coins to secure the network, and you generate a yield for doing so. Mechanically, to an outsider, that sounds dangerously close to earning interest on a bank deposit.
That is precisely the knife's edge of the debate. To bridge the centuries, scholars look at the actual function of the validator.
What's the consensus?
Well, the contemporary mainstream view leans toward it being permissible by comparing staking to holding a deposit as a guarantee while you provide a service. In this case, cryptographically securing the network.
Oh, okay.
Crucially, you bear real risk because your staked assets can be slashed or penalized if your validator node misbehaves or goes offline.
So it's classified as service income, not a passive guaranteed interest payment.
Correct. However, stricter scholars look at the fact that the yield is denominated in the exact same asset you locked up. To them, the mechanics feel indistinguishable from a deposit with interest arrangement, crossing the line into riba.
Wow. What I appreciate about Coach Zubair's guides is that they also highlight the universal agreements.
Yeah, stuff everyone agrees on.
Right. Even in this frontier market, all scholars agree on what is absolutely forbidden futures, perpetual contracts, meme coins with no utility, and crypto lending platforms paying fixed yields are all strictly out.
Completely out. And while the new spot Bitcoin ETFs like EBIT solve the custody and anonymity issues, making the investment a cleaner structural wrapper, they don't resolve the underlying theological debate of whether Bitcoin is actually money.
Right.
The vital takeaway here is do not chase internet fatwas. If you are deploying meaningful capital into crypto, you need to consult a local scholar you actually trust and understand the mechanics of what you are buying.
Which brings us to the final piece of the puzzle. Knowing what to buy, whether it's an ETF or Ethereum, only matters if you know how to manage the trade without letting your emotions break the rules.
The psychology of it all.
Exactly. The sources emphasize that financial discipline is just as mandatory as Sharia compliance. Protecting your capital from emotional, speculative decision-making is essentially another way of avoiding Gharar.
The guides actually provide a very mechanical framework to prevent that emotional speculation. It starts with the buy zone DCA strategy.
How does that differ from regular DCA?
Well, instead of dumping your entire cash position into an asset on a random Tuesday, you split that cash into 3 to 5 portions. You wait patiently until the asset drops into a historically attractive price band, and you buy progressively as the price moves through that zone.
I like that. And then comes the exit strategy, which offers this incredible psychological trick, the TP1 or Take Profit 1 strategy.
This is a game changer for a lot of people.
It really is. When an asset hits your first calculated target, you sell 50% of your position. Then you move your stop loss up to your original entry price, your break-even point.
Yeah.
You've essentially built an emotional safety net. It's like playing with the house's money at a casino. You literally cannot lose money on the remainder of that trade. You are letting the rest ride with zero risk to your principal.
This raises an important question, though, about knowing yourself as an investor. Are you executing an active swing trade, or are you a long-term accumulator?
That's a huge distinction.
Massive. That TP1 strategy with mechanical trail and stops is brilliant for active trading, but it can be completely disastrous for long-term core holdings.
Why is that? What's the mechanical difference?
Imagine you hold SPUS, that diversified halal ETF we talked about, for the long haul. If the broader macroeconomic market drops 20%, a mechanical stop loss will trigger and sell your position right at the absolute bottom.
Ouch.
Right. But for a long-term accumulator, a 20% drop in a broad compliant index isn't a failed trade thesis, it's a massive buying opportunity. You should be deploying more capital, not panic selling.
So you really have to define your time frame and your risk before you ever click buy. And speaking of risk, the guides emphasize that position sizing should be based on risking 1 to 2% of your account on a potential loss, not 1 to 2% of the total account value.
Yes, that math is crucial.
Right. If you have a $10,000 account and your risk is 1%, you size the shares so that if your stop loss triggers, you only lose $100.
That math is literally the only thing that keeps you in the game long enough to let your winners compound.
Absolutely.
And for our Canadian listeners, the sources drop a massive logistical tip regarding how you set up your accounts, specifically comparing Wealthsimple to Questrade.
Oh, this is a huge optimization. Most of these halal ETFs are priced in US dollars. If you buy them on a platform like Wealthsimple using Canadian dollars, you get hit with a 1.5% foreign exchange fee on the way in and another 1.5% on the way out.
It's brutal.
It is. That 3% spread absolutely destroys your compounding returns over time. The strategy the sources recommend is opening a tax-free savings account at Questrade and executing something called Norbert's Gambit.
It sounds incredibly complex, but it's really just a mechanical workaround to bypass the broker's massive exchange fee.
Exactly. Here is how it practically works. You take your Canadian dollars and buy a dual-listed ETS, usually the Horizon's US dollar currency ETF, ticker DLRTO.
Okay.
You then call or chat with your broker and ask them to journal those exact shares over to the US dollar version of that same fund, which is DLRUTO.
Right, just switching the currency side.
Yeah. Once the shares settle on the US side of your account, you sell them. You are now holding US dollars at the spot exchange rate, bypassing the 1.5% fee entirely.
It's those precise mechanical optimizations, cutting exchange fees, managing exact risk per trade, holding assets in tax-advantaged accounts that combine with the core halal principles to build real wealth over decades.
Truly, when you step back and look at this entire journey, it forces a profound level of discipline on you as an investor. No extreme leverage. You must own equity in real, tangible assets. You are required to avoid panic selling and focus on the underlying business.
It builds incredibly strong habits.
It really does. It coincidentally mirrors the exact habits and advice of the world's most successful traditional investors. It's just a different, deeply intentional path to the exact same core truths of wealth building.
Absolutely.
Remember, as always, to do your own due diligence and consult professionals for your specific situation.
It really is a masterclass in disciplined capital allocation. And, it leaves me with a final thought for you to ponder.
Let's hear it.
We just spent a lot of time analyzing how these Islamic financial principles structurally prevent massive leverage. They inherently screen out companies that are burdened by debt, and they explicitly forbid trading in complex, opaque derivatives.
Right, the GRAW.
Exactly.
Yeah.
Now, if we look back at the global financial crisis of 2008, that entire catastrophe was built almost exclusively on toxic, highly leveraged debt and opaque derivatives mechanisms that are completely outlawed in this framework.
Yeah.
So imagine if the entire global financial system operated strictly under these rules. If an entirely halal-compliant global economy was the standard, would it be fundamentally immune to the massive systemic financial crashes we've come to accept as normal? Are these ancient rules actually the ultimate modern stress test for a stable economy?